Let me tell you something that might surprise you over the years. People have asked me thousands of questions about investing. They want to know which stocks to buy, when to sell, how to time the market. But one question keeps coming up more than almost any other. Warren, what should I do with my 400 wonk? Should I use those target date funds everyone's talking about? Here is what I want you to understand. I've never specifically endorsed target date funds. In fact, I've been skeptical of them for a very specific reason that I'll explain. But before we get into that, let me tell you what I have endorsed loudly and repeatedly for the last several decades. Back in 2013, I did something that raised eyebrows across Wall Street in my annual letter to Berkshire Hathaway shareholders. I revealed the instructions I'd given to the trustee of my estate. When I'm gone, here is what should happen to the cash. I leave my wife. Put 90% into a low-cost S&P 500 index fund and 10% in short-term government bonds. Think about that for a moment. I've spent over 60 years studying businesses, analyzing financial statements, and making investment decisions. I've built Berkshire Hathaway into one of the most successful investment vehicles in history. And yet, for my own wife's inheritance, I am not recommending a carefully curated portfolio of individual stocks. I am not suggesting she hire expensive money managers. I am telling her trustee to buy a simple index fund and forget about it. Why would I do that? Because I've learned something that most people on Wall Street don't want you to know. The vast majority of investors, including professionals who do this for a living, cannot beat a simple S&P 500 index fund over long periods of time. And when you factor in the fees they charge for trying, they fall even further behind. Let me give you some numbers that might shock you. Over the 10 years ending in 2022, only about 10% of actively managed funds beat their benchmark index. That means 90% of the professionals, the people with MBAs and fancy offices and teams of analysts, failed to do better than a simple index fund that anyone can buy with a few clicks. But here is the part that really hurts. Even that 10% who beat the market in one decade often don't repeat that performance in the next decade. It is not skill, it is luck, and you can't invest in luck. Now, you might be wondering, Warren, if these professionals are so smart, how come they can't beat the index? The answer is simple: fees. Let me walk you through the math because this is important. Let's say you invest $100,000 in your retirement account. Option one, you put it in a low-cost S&P 500 index fund charging 0.03% annually. That is 3 cents for every $100 invested. Option two, you put it in an actively managed fund or more expensive target date fund charging 1% annually. 1% doesn't sound like much, right? It is just $1 for every $100. But watch what happens over 30 years. If the market returns 10% annually before fees, and you are paying 0.03% in fees, you'll end up with about $1.74 million. But if you are paying 1% in fees, you'll end up with about $1.32 million. That is a difference of $420,000. Nearly $500,000 gone, not because you made bad investment choices, but simply because you paid higher fees. And here's the worst part. Many target date funds charge even more than 1%. Some charge 1.5%, 2%, or even higher when you factor in the underlying fund expenses. Every additional percentage point in fees is another chunk of your retirement vanishing into someone else's pocket. I've been warning people about this for decades. In 2016, I even made a famous bet. I wagered $1 million that a simple S&P 500 index fund would beat a collection of hedge funds over 10 years. The hedge funds could pick their best managers, use sophisticated strategies, do whatever they wanted. I just bought the index fund and waited. What happened? By the end of 2017, the bet was essentially over. The index fund had crushed the hedge funds. It wasn't even close. And remember, these were supposed to be the best, the smartest people in finance. They still couldn't beat a simple index fund after accounting for their fees. Now, let's talk about target date funds specifically, because this is where things get interesting first. Let me explain what these funds actually do. A target date fund is designed for people planning to retire around a specific year. You might buy a 2050 target date fund if you are planning to retire around 2050. The fund automatically adjusts its asset allocation over time, starting with more stocks when you are young and gradually shifting to more bonds and conservative investments as you approach retirement. On the surface, this sounds sensible. It is a set it and forget it approach. You don't have to think about rebalancing your portfolio or adjusting your risk as you get older. The fund does it for you. But here is my concern, and it is a big one. Many target date funds are expensive. They're often built as funds of funds, meaning they invest in other mutual funds and you end up paying layers of fees. The target date fund charges a fee, and the underlying funds that invest and charge their own fees. Those costs add up quickly. Let me give you a real example. Some target date funds charge expense ratios of 0.75% to 1.5% or more. Compare that to a simple S&P 500 index fund charging 0.03% to 0.04%. Over a 40-year career, that difference in fees could cost you hundreds of thousands of dollars, maybe even more than $1 million, depending on how much you save. Now, I am not saying all target date funds are bad. Some companies, particularly Vanguard and Fidelity, offer low-cost target date funds built on index fund principles. If you can find a target date fund with an expense ratio under 0.15% and you genuinely value the automatic rebalancing feature, then it might be a reasonable choice. But here's what I want you to understand. You don't need a target date fund. The strategy they implement is not complicated. You can do it yourself with 2 or 3 simple index funds and spend 30 minutes once a year rebalancing. Let me tell you what I do if I were a typical investor saving for retirement. It is almost embarrassingly simple. When you are young, let's say in your 20s, 30s, and 40s, put almost everything in a low-cost S&P 500 index fund, maybe 90% or even 100%. You've got decades until retirement. You can handle the volatility, and over long periods, stocks have historically provided the best returns of any major asset class. As you get closer to retirement, start shifting gradually toward bonds. By the time you are in your 50s, maybe you are at 80% stocks and 20% bonds. In your early 60s, perhaps 70% stocks and 30% bonds. By the time you retire, you might be at 60% stocks and 40% bonds, or even the 90-10 split I recommended for my wife. That is it. That is the whole strategy. You don't need fancy software. You don't need expensive advisors. You don't need target date funds that charge you for doing something you could do yourself in less time than it takes to watch a sitcom. Here is what this approach gives you. Maximum simplicity, minimum fees, broad diversification across the 500 largest companies in America, and a proven track record spanning over a century. Now, I know what some of you are thinking, but Warren, what about market crashes? What about 2008 when the market dropped 37%? Shouldn't I try to avoid those losses? Let me tell you a story. In 2008, when the financial crisis hit and the market was crashing, I wrote an op-ed for the New York Times. The headline was, "Buy American, I Am." This was in October 2008, right in the middle of the panic. The market had already fallen sharply, and most people thought it would fall further. I wrote, "Bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price." And I meant it. When prices fall, that is not a time to panic. It is a time to buy. But here's the problem. Most people can't do that emotionally. When the market drops 30%, they panic and sell. They lock in their losses. Then when the market recovers, they're too scared to get back in, so they miss the gains. This is where target date funds can actually help some people. Not because they provide better returns, they don't, but because they prevent you from doing something stupid. If you've committed to a target date fund and you are automatically contributing every paycheck, you are less likely to panic and sell when the market drops. You are less likely to try to time the market. You are less likely to make emotional decisions that destroy your wealth. So here is the honest truth. If you are the kind of person who will panic during market downturns, if you are tempted to check your portfolio every day and make changes based on news headlines, if you think you can time the market, then maybe a low-cost target date fund is worth it for you. The slightly higher fees might be a reasonable price to pay for the discipline it imposes. But if you can stay disciplined, if you can commit to investing regularly regardless of what the market does, if you can ignore the daily noise and focus on the long term, then you are better off with a simple S&P 500 index fund. And doing the rebalancing yourself. Let me share something that should give you confidence in this approach. I've lived through more market crashes than I can count. The Cuban Missile Crisis in 1962, the oil crisis in the 1970s, Black Monday in 1987 when the market dropped 22% in a single day, the dot-com crash in 2000, the financial crisis in 2008, the COVID-19 crash in 2020. Every single time the same thing happened, people panicked. They said, this time is different. They sold their stocks and ran for safety. And every single time, those who stayed invested or bought more during the panic were rewarded. If you had invested $10,000 in an S&P 500 index fund in 1980 and just left it alone, do you know how much you'd have today? Over $1 million. That is through multiple crashes, recessions, wars, terrorist attacks, and pandemics. The market went up, the market went down, but over the long term, it went up a lot more than it went down. And here's the beautiful part. You didn't need to pick the right stocks. You didn't need to predict which sectors would do well. You didn't need to time when to get in and out. You just needed to own a piece of American business and be patient. That is what an S&P 500 index fund gives you. You own a slice of the 500 largest companies in America. You own Apple and Microsoft and Amazon and Google and ExxonMobil and Johnson & Johnson and hundreds of others. When new companies become successful, they enter the index. When companies decline, they drop out. The index automatically updates itself to reflect the most successful businesses in America. Now, let's talk specifically about retirement planning, because this is where target date funds are most commonly used. When you are saving for retirement, you've got three main goals. First, you want your money to grow as much as possible. Second, you want to protect yourself from running out of money. Third, you want to do this with as little stress and complexity as possible. Target date funds promise to help with all three goals. They invest aggressively for growth when you are young. They automatically become more conservative as you age to protect your nest egg. And they do it all automatically, so you don't have to think about it. But here is what they don't tell you. That automatic adjustment, that glide path from stocks to bonds, is based on your age, not your personal situation. It doesn't know if you are healthy and might live to 100, or if you have health problems and might need your money sooner. It doesn't know if you are a millionaire with plenty of savings, or if this retirement account is all you've got. It doesn't know if you have a pension that covers your basic expenses, or if you are entirely dependent on this money. One size does not fit all. A 65-year-old retiring with $5 million in savings can afford to take more risk than a 65-year-old retiring with $200,000. But most target date funds treat them the same way. Let me give you a personal example. I am 95 years old. According to target date fund logic, I should have almost all my money in bonds and very little in stocks. But you know what? I actually hold mostly stocks. Berkshire Hathaway's portfolio is predominantly equities. Why? Because I don't need to spend this money in the next few years. I am investing for the long term, even at 95. The point is, your investment strategy should be based on your specific situation, not just your age. And while target date funds use age as a convenient proxy, it is a crude tool that doesn't account for individual circumstances. Let me tell you about some costs that many people don't even realize they're paying with target date funds. First, there is the expense ratio I already mentioned. But second, there's often a lack of tax efficiency. Many target date funds generate capital gains distributions when they rebalance, and you end up paying taxes on those gains even though you didn't sell anything. Third, there is the cost of complexity. When you own a target date fund, you are actually owning a bunch of different funds underneath. Good luck trying to understand exactly what you own and why. With a simple S&P 500 index fund, you know it. Exactly what you own, the 500 largest public companies in America. Fourth, there is the opportunity cost. Many target date funds shift too conservatively too quickly. By the time you are 50 or 55, they might have you in 40% or 50% bonds. But if you've got 30 or 35 years left to live, which many people do, you are giving up decades of potential stock market growth. Here is something that might shock you. A person retiring at 65 today might live another 25 or 30 years. That is long enough for stocks to go through multiple cycles. Even in retirement, you need growth. You can't just hide in bonds and hope your money lasts. With inflation running at 2 to 4% annually, bonds barely keep up. Stocks are what provide the growth you need to maintain your purchasing power over a long retirement. If I were a 30-year-old starting my career today, here's exactly what I'd do. Every month, automatically invest a portion of my paycheck into a low-cost S&P 500 index fund. I'd aim to save 15 to 20% of my income, if possible. But even 10% consistently invested will build substantial wealth over time. I wouldn't look at my account every day. I wouldn't check it every week. Maybe once a quarter, I'd glance at the statement, nod, and move on with my life. I certainly wouldn't make any changes based on news headlines or market predictions. If the market crashed 30%, I'd keep investing. If it crashed 50%, I'd keep investing. In fact, I'd be thrilled because my monthly contributions would be buying more shares at lower prices. As I got into my 50s, I'd start gradually adding some bonds to reduce volatility. Maybe I'd aim for 20% bonds by age 55, 30% by age 60, and somewhere between 30% and 40% by retirement. But I'd never go below 50% stocks unless my health was failing or I had special circumstances requiring more liquidity. That is it. That is the whole plan. And I guarantee you, over 30 or 40 years, that simple approach will beat 90% of the fancy strategies, expensive funds, and hot tips you'll hear about. Here is what I want you to ask yourself. Are you paying for performance or are you paying for convenience? If you are paying 1% or more for a target date fund, you need to decide whether that automatic rebalancing and age-based adjustment is worth potentially hundreds of thousands of dollars over your lifetime. For some people, maybe it is. If it keeps you from panicking during crashes, if it prevents you from making emotional mistakes, if it gives you peace of mind, then perhaps it is worth the cost. But for most people, I believe the better answer is to take an hour to understand basic asset allocation. Set up automatic investments into a low-cost index fund and rebalance once a year by shifting a bit more into bonds as you age. That hour of learning and 30 minutes of annual maintenance could save you more money than you'd earn working full-time for several years. Let me put it another way. If someone offered to pay you $300,000 to spend 1 hour learning about index funds and 30 minutes a year rebalancing your portfolio, would you do it? Of course you would. Well, that is essentially what you are leaving on the table by paying. Now, let me be fair, there are situations where target date funds make sense, but only if they meet certain criteria. First, the expense ratio must be very low. I am talking 0.15% or less. Vanguard's target date funds, for example, charge around 0.08% to 0.15% depending on the fund. That is reasonable. Fidelity offers similarly low-cost options. If you are paying more than 0.20%, you are paying too much. Second, the fund should be built on index fund principles, not actively managed. You want the underlying holdings to be broad market index funds, not actively managed funds trying to beat the market. Third, you need to understand the glide path. How quickly does the fund shift from stocks to bonds? Some are more aggressive, staying stock, heavy longer. Others are more conservative, shifting to bonds earlier. Make sure the fund's approach matches your situation. Fourth, and this is critical, you need to commit to staying invested. The worst thing you can do is use a target date fund for 10 years, panic during a crash, sell everything, and then try to time when to get back in. If you are going to panic, no investment vehicle can save you from yourself. If you can find a target date fund that meets these criteria and you genuinely prefer the set and forget its convenience, then go ahead. But understand that you are paying for convenience, not superior returns. Let me tell you something I've observed over 60 years. The financial industry does not always have your best interests at heart. I know that sounds cynical, but it is true. Most financial advisors, most fund managers, most people selling investment products get paid based on the fees you pay. The more complex the product, the higher the fees, the more money they make. Do you see the conflict of interest? This is why so many advisors push target date funds, managed accounts, actively traded portfolios, and other expensive products, not because these products are better for you, but because they generate higher fees. I've been in this business long enough to see countless examples of financial firms putting their own interests ahead of their clients. They'll recommend the fund that pays them the highest commission, not the fund that is best for you. They'll encourage trading and activity because every trade generates fees. They'll make things seem more complicated than they are because if you knew how simple good investing actually is, you wouldn't need them. Here is a test. If a financial advisor tells you that you absolutely must use target date funds or any other complex product, ask them one simple question: how much are you getting paid from this recommendation? Watch them squirm. If they're not willing to clearly disclose their compensation, walk away. The beauty of a simple S&P 500 index fund is that nobody makes much money from it. There is no advisor commission. There is no sales load. There is just a tiny annual fee to cover the fund's operating costs. The fund company makes a little bit, but not enough to get rich. And that is exactly what you want. Every dollar that goes into their pocket is a dollar that is not going into your retirement. I want to come back to something I mentioned earlier because it is important. The biggest enemy of investment success is not the market. It is not the economy. It is not inflation or recessions or bear markets. The biggest enemy is yourself. Most people destroy their own wealth through emotional decision making. They buy when prices are high because they're excited and everything seems great. They sell when prices are low because they're scared and everything seems terrible. They do the exact opposite of what they should do. This is why I told my wife's trustee to put 90% in an index fund and just leave it there. It removes emotion from the equation. It removes the temptation to do something. It forces discipline. If a target date fund provides that same discipline for you, if it prevents you from making emotional mistakes, then maybe it is worth slightly higher fees. Think of those fees as the cost of protecting yourself from yourself. But here's what I'd rather see. I'd rather see you develop the discipline yourself. I'd rather see you commit to a simple strategy and stick with it through thick and thin, because once you develop that discipline, you don't need the training wheels anymore. You can use the simplest, cheapest investment vehicle available and maximize your returns. How do you develop that discipline? Start by understanding that market volatility is normal. The stock market goes up about 3 out of every 4 years, but that means it goes down 1 out of 4 years. Those down years are not exceptions. They're part of the deal. If you are going to panic every time the market drops, you shouldn't be in stocks at all. Second, stop checking your portfolio constantly. Looking at your account balance every day is like weighing yourself every hour when you are trying to lose weight. The daily fluctuations are meaningless noise. What matters is the long-term trend. Third, automate everything. Set up automatic contributions from your paycheck. Don't give yourself the option to skip a month because the market is down or you are worried about the economy. Just keep investing mechanically, month after month, year after year. Let me summarize everything I've told you because this is important. For most investors, a low-cost S&P 500 index fund is the best choice. It is simple, it is cheap, it works. Over long periods, it beats the vast majority of alternatives. Target date funds are not inherently bad, but many of them are too expensive. If you are going to use one, make sure it charges less than 0.15% annually and is built on index fund principles. The automatic rebalancing that target date funds provide is convenient, but it is not complicated to do yourself. Once a year, you can adjust your stock to bond ratio based on your age and circumstances. It takes less than an hour. The most important factor in investment success is not which fund you choose. It is whether you can stay disciplined and keep investing through market ups and downs. If target date funds help you maintain that discipline, they might be worth slightly higher fees. But if you can maintain discipline on your own, you are better off with the simplest, cheapest option. Don't try to time the market. Don't chase hot stocks or sectors. Don't pay high fees for active management. Just buy a broad index of American businesses, invest regularly, and be patient. That approach worked for me. It worked for millions of others, and it'll work for you, remember. In investing, the goal is not to do something clever or exciting. The goal is to end up with enough money to live comfortably in retirement. Boring works, simple works, cheap works. That is all you need to know. As I prepare to hand over Berkshire Hathaway to Greg Abel, I am comfortable knowing that the investing principles I've taught for decades will continue to work long after I am gone. These principles don't depend on any individual person. They don't depend on market conditions. They're based on mathematical reality and human nature, and those things don't change. Whether you use a target date fund or a simple index fund, the most important thing is that you start investing now and keep at it. Time is your greatest asset when you are young. The compounding of returns over decades is what builds real wealth. Don't waste time trying to find the perfect investment. The perfect investment is the one you'll actually stick with through the long haul. That is the only investing wisdom I've ever had, and it is the only wisdom you'll ever need. High fees for someone else to do something you could easily do yourself.